Good afternoon. Bonjour tout le monde. Welcome to the Canadian Housing and Renewal Association's webinar called Affordable Homeownership by Nonprofits, the Shared Equity Mortgage Model. My name is Jeff Morrison. I'm the Executive Director here at CHRA. I'll be moderating today's webinar. And thank you all for joining, and we know that there are people joining still as I'm talking. So welcome to all of you. I will apologize. I'm suffering from a bit of a summer cold, so apologies if I start going on a coughing fit or something like that. So before we begin, I just want to give a brief overview of this webinar technology. I'll then introduce the agenda and speakers for this afternoon's presentation. So first of all, this webinar is in real time, so you should now be able to see a title screen of today's presentation and be able to hear me via your computer speakers, your headset, or through the telephone if you've dialed in. You're currently all muted, and we do this to minimize any background noise. But if you do wish to ask questions, and we encourage you to do questions and comments, please type in your question into the question dialog box on the webinar control panel at any time in the presentation. Please indicate the speaker that you would like to respond to your question, and we'll come to all of those questions and comments at the end of the various presentations. I would add that si vous voulez poser une question en français, c'est bien apprécié et nous encourageons de le faire. On va traduire les questions en français pour le bénéfice de nos présentateurs. Mais s'il vous plaît, si vous voulez poser une question ou un commentaire en français, vous êtes très content de le faire. So if you do have a question in either official language, please do so. For the benefit of our panelists, we'll translate questions. So moving on to today's webinar topic. Excuse me. So as many of you may know, on June 17th, a few weeks ago, CMHC announced the Shared Equity Mortgage Provider Fund, or SEMP Fund for short, a program to help eligible Canadians achieve affordable homeownership. This 5-year program will provide up to $100 million in lending to shared equity mortgage providers over a 5-year period to help them scale up their business and encourage new players to enter the market and increase capacity. So today's webinar will introduce the shared equity mortgage model as it's being used by nonprofits for facilitating affordable home ownership. So our speakers will present the model that they are using in their programs and discuss why it matters in the affordable housing spectrum. In addition to that, we're very pleased to have a representative from CMHC who will provide an update on the Shared Equity Mortgage Provider Fund, or SEMP Fund. So there are a few nonprofits in Canada who have been in the shared equity mortgage business for some time, and today we're going to hear from 3 of them. So I'd now like to introduce our speakers for the day. First of all, I mentioned from CMHC, we're joined by Catherine Lawler, who is a policy advisor at CMHC and is working on the team responsible for implementing the $100 million SEMP Fund, and Catherine is in Ottawa. We're also pleased to be joined by Joe Deschênes-Smith, who is the principal and founder of Trillium Housing based in Toronto. Trillium Housing provides eligible home purchasers, those with incomes below local median income, with a shared appreciation mortgage. And Joe will talk in a few minutes about his model. We're also joined by Heather Tremaine. She is the CEO of Options for Homes, also based out of Toronto. Options for Homes has been in the affordable homeownership sector for over 25 years. Options is a developer and has completed over 3,000 units to date, and we look forward to hearing from Heather. And last, but of course certainly not least, we're joined by Patrick Pretty, who is the project coordinator at La Société d'Habitation et de Développement de Montréal, SHDM, who runs the Accès Condo program in Montreal. And for those of you unfamiliar, in Montreal, Accès Condo is part of the SHDM, which is a nonprofit agency of the City of Montreal. Accès Condo program provides credits, affordable and quality built units through agreements with developers and provides 10% down payments to purchase accredited units. So again, we'll be hearing from Patrick shortly on the AXA condo model. So with that, I want to thank all of our speakers who are here, thank all of our attendees, and with that, I will pass it over to Catherine Lawler from CMHC to provide an update on SEMP. Catherine, the floor is yours.
Thank you. Well, first off, I just really appreciate the opportunity to be here. So thank you to the Canadian Housing and Renewal Association for the platform and bringing us all together. I think you're going to, yeah, great. So for all the attendees and other panelists, I thought I would promote CMHC's corporate website for the Shared Equity Mortgage Provider Fund program. There's some information online right now, but we are planning to update this in the coming weeks in preparation for our July 31st launch. So this is where you'll be able to find the application form, the supporting documentation and all that kind of stuff. So just to get people familiar with it. It was already mentioned, so the fund was announced in budget 2019. It didn't get as much real estate as the first-time homebuyer incentive, but equally important, but smaller in size. So we're happy to be supporting providers of shared equity mortgages through this program. And I think it's really important. We're working through the program design and how we're going to deliver it. But I think a big thing to draw attention to is that the program itself is supposed to be flexible in design. And we're trying to recognize that not all models work the same way, or that someone may come to the table with something a little bit different than what's been done in the past. And we just want to reiterate that we're open to that. So when the time comes to review the application form, I just don't want anyone to feel constrained, and that unique ideas are certainly welcome. What else can I go through? So there's two streams in the program. I'm not sure if everyone's had a chance to read up on them, but the first stream is the pre-construction stream, which is essentially repayable loans that would be made available for the upfront pre-construction costs for moving forward with a housing development. So basically everything that happens kind of right up until land acquisition. And so that really is targeting sort of the new supply angle. When the second stream is really a repayable loan that would be provided to a provider of shared equity mortgages that would in turn be benefit first-time home buyers by way of secondary financing. So those are the two big streams. I'll highlight that on our website, we mentioned that there's no stacking between the streams. There's a bunch of reasons for that, but just to highlight from a practical perspective, it's only a 5-year program. And so the likelihood of getting through the stream one, actually building the units, and then being coming forward for stream two from a practical perspective, it's not realistic. What else here? Eligibility. So nonprofits, government, Indigenous governments or organizations, and for-profit organizations are all eligible under the program. We're not sure exactly what the demand is going to be, but we do have some prioritization criteria that we're ironing out now, that in the event we would be oversubscribed, we'd be in a position to prioritize funding. The loan details, again, this will be updated in the coming weeks with more detail. But basically for the pre-construction stream, the only real criteria is that we would work with the proponent to ensure that a certain percentage of the project or the proposal goes towards first-time home buyers who are able to provide 5% of a down payment from their own resources. The maximum loan amount is $4 million. The term would be 5 years. The interest rate would be a nominal amount, money that we would get through the Crown Borrowing Program. The second stream, there's more criteria here in that all of the shared equity mortgages would go towards first-time home buyers that can provide a 5% down payment, so slightly different. There's no maximum loan size per se, although on a per proponent borrower basis per year, it would be $5 million. The loan term will be sort of negotiated with the proponent, but the maximum amortization period here is 26 years. That's what they're referring to. And again, the interest rate would be nominal based on what we can do through the Crown Borrowing Program. So I can't go into too much detail on the program design at this time, but I do want to open it up either through the questions or through the other panelists that I am listening. So if there's things that you want me to take offline or specific questions that you have, that I think this is a good avenue for us to ensure that we design and deliver a program that works for our key stakeholders. So I'm looking at the clock here. I want to make sure I leave lots of time for questions. So.
Great. Well, thank you, Catherine, for that overview. We will definitely have time for questions at the end. And I should also add, and I'll talk more about this at the end of the webinar, but CHRA has just created a brand new affordable homeownership working group for members. So that will serve as a really excellent forum for concerns, ideas, questions regarding the SEMP fund. So we'll be sure to maintain a good relationship with you once that working group is in place. So thank you again, and we'll now turn things over to Joe Deschênes-Smith, Principal and Founder of Trillium Housing in Toronto. Joe, the virtual floor is yours.
Great, thank you very much. Has my screen popped up? Okay, so I got to go back a couple, sorry about that. So thanks very much, and I'm going to start with a thank you, which is, I think, the critical thing. I've had, I don't know how many hours of conversations with folks at CMHC and the government, and I'm going to actually name names because, people like Vicky Martins and, of course, Catherine, Don O'Donnell, Carlos Mandujano in the finance section, Charlie MacArthur has been in our discussions, Debbie Stewart, Nathan Joshua. I particularly want to thank Michelle McMaster, who's our local Toronto contact and conduit into the CMHC. And I've also had lots of discussions with Minister Duclos' office, Dylan Mirando, and Minister Morneau's staff, particularly Ben Chin. All these folks have been really helpful, and after years of advocacy, we're so excited to see this program come out, both the national program that CMHC will be running in the fall, and the SEMP. This slide, which no one can read, and that's partly on purpose, it's actually a picture of our submission for the SEMP that we made and that the CHRA board, I think, discussed several weeks ago, just before the program was launched, I think, earlier than we anticipated. And I want to thank CHRA for the work and the discussions with Jeff and bringing our affordable ownership piece to the board. And I'm glad at that meeting, that things were rolling in terms of advocacy and getting the program out. And also thank the CHRA for launching the working group, and as we discussed at the time, I'll give an advertisement for myself. I'm going to do another session with CMHC on this topic at the ONFA conference in the fall, and that's what I had mentioned to Jeff that led to the webinar, and we're happy to do it. The three top items on that 2 pages, which is a list of a whole bunch of technical things that we had suggested to CMHC and the federal government for the program. The number one was we had suggested that there'd be leverage in the program, in that we be expected to match the dollars put into shared equity mortgages. And tied to that is our number 2 ask, which is that the funding be subordinate. And that in that sense, so if we were able to bring in money and support our families, that the CMHC dollars be put at more risk. The third piece, and I have top 3, and I won't go into any more, was that the program be exclusively available initially to nonprofits. And I know there was a decision not to do that. I'll continue the advocacy, ourselves, and I certainly have to mention Habitat, the people on the panel, and Attainable Homes in Calgary. Those are the pioneers in the space. We can, I believe, easily deliver a lot more impact and do it more effectively than the private sector. And I'll just leave my pitch at that. And if you want to see other Trillium housing submissions to government, you're welcome to go to our website. I'm going to skip through this side pretty quickly, but it's some of the things that we think the shared equity mortgage tied in with conventional housing development can do that's innovative. So it allows you to leverage in impact investment community. All right, so I was going through kind of some of the attributes of the shared equity mortgage built into conventional development. I won't go through all of those in the interest of time. I like this graph. If you look at 1997, which is about the middle, you'll see that the average cost of ownership housing in Canada, in the mid to late 1990s, was roughly around 35% of income. And you'll note today, or in 2017, that number starts to approach 50%. So that's my, what's the problem slide. Well, I don't think I need to talk about that in great detail. Everyone gets it. What does Trillium Housing do? Just very quickly, our model is to basically invest in partnership with conventional developers. We have deliberately designed a program that is flexible and can be kind of plug and play in different corporate structures and work with different size of projects and developers and proportions of delivery. We're looking to tap into the impact investment community, so foundations and high net worth individuals who are looking for both a financial return and also, most importantly, the social impact. Finally, the Trillium mortgage, which I'll go through in more detail, is like most shared equity products, it's payment free until discharge, and that includes either the resale or a renting out of the home. Who we are. So I established Trillium Housing just 4 or 5 years ago. The other 2 partners are Fred Heller and Richard Owen. Fred has got 50 years of experience in construction management, and as a fixer. So he's gone in and salvaged projects in Markham, Toronto, Kemptville, even the Trump Tower when it was under construction and was going a bit sideways. Fred was the guy they brought in to fix it. Richard Owen has got a long career in real estate finance and development, both on the private side in Calgary with the Karma Group, in Ottawa, and also later on in his career with Metro Housing in the reorg there, Toronto Community Housing. He was the first one to do a Regent Park revitalization program, and he also spent a decade on the board of Meridian Credit Union. The rest of our board, many of you may recognize those names. Certainly Bridget Wachowski, who was the chair of CHRA for some time, and I won't even go into the others in their experience, but it's certainly a team that I'm proud to be affiliated with and happy to have them support us. I'll take a minute or two on this slide, which I'm hoping you can see okay. basically, we have two outcomes in our model and in the use of the shared equity mortgage. The first one is to reduce the housing cost, and by providing a mortgage for a portion of the value of the home, which we do, and making that payment free, we have a direct reduction in the housing costs of families. And so we give an example here where the family looks to purchase a $350,000 home. They are providing the 5% down payment, and that is part of our standard policy at Trillium. So I'm glad to see that it's replicated in the SEMP fund program criteria. In this example, we're providing a Trillium mortgage of $87,000, and that represents 25% of the value of the home. And the family has an income that can afford a $240,000 mortgage. In today's market, at these interest rates, probably earning $60,000, $70,000 a year. Their monthly mortgage payment ends up being $1,400 a month at that rate, and this is given, I forget exactly when we did this chart, last year sometime, and the savings for the family, and that's kind of our first outcome for Trillium Housing, is a reduction of about $500 a month. So instead of having to carry the $87,000 in their mortgage, they're saving $500 a month, and that's the principal direct cost savings on the housing and the housing affordability deliverable that we have. The second kind of plank in our program is to help families to build equity and using home ownership kind of as a forced savings vehicle. So if we follow up the example and they sell 10 years later for $470,000, and I believe that works out to about a 3% per annum increase on average, they obviously discharge their outstanding first mortgage, which 10 years later would have a capital value of $180,000. They pay back Trillium Housing their $87,000 plus 25% of the $120,000 in equity increase, and then they end up at the end of 10 years with family equity of about $170,000. So from our point of view, we've set the family up for housing success into the future, providing them equity, whether that be for the purchase of another house or to invest in their family in other ways, whether it be education or business, etc. So we see the Trillium mortgage and the details that have been released so far on the shared equity program being released in the fall as pretty similar, and we hope that it will be able to achieve the same type of outcomes. So going from the theory of that chart, I thought I would provide some results of real people at our project here in Toronto that will start occupancy in August. So what I've done is taken 3 actual purchasers at our project, The Loop, which is a 62-unit stacked townhouse development, Rogers Road in Weston. It's called The Loop because it's the former TTC turning circle for the old streetcar line that used to be on Rogers Road. And we purchased it as a surplus site with a commitment of a loan from the city to help with affordability. So you'll see, in that project, all of the Trillium Mortgage Finance families, 33 of them out of 62 units, bought 2 and 3 bedroom units. I list there the housing prices that go from $350 to $550, and those are, we work with developers that will produce entry-level priced housing, and in that market, that's the entry-level price point. Obviously, there's the 5% down. There's the first mortgage amounts that they could afford and which were provided. And I want to shout out to Duca and Viridian Credit Unions, who were our partners in providing our clients with first mortgage and did some fantastic work with us. And then we basically right-size our Trillium mortgage to each individual family's circumstance. And as you can see, one family had a household of 1, so it's a single person, and up to a family of a single mother with 3 children. So the amount of Trillium mortgage depends not only on the income, but we look at other family situation, any debt, et cetera, that they're carrying. The household incomes and obviously the savings and their housing costs are listed as well. We're super excited at the outcomes that we were able to custom design the Trillium mortgage to each family's need And as the chart says, we achieved for our 33 families an average household income in the mid 60,000s, and in the Toronto market, pretty exceptional to be buying a home at that level. So moving along, I love this chart. I wish CMHC would produce it again. Catherine, if you can help. This was from a presentation I saw many years ago, and you'll see the data is from 2007. It's interesting in that it shows kind of for families that own their house for the number of years or months listed on the chart, what percentage of the home do they have built up as equity in that home? So people who owned a home in 2007, surprisingly, it says that they have 5% of the equity. I would have thought it'd be higher. But then you see each year, or that or each month, an increase in the percentage value of the home that's owned by the family. So that at the end of 5 years, 60 months, the 60 is not on there, you're at about 48% of the equity home owned by home. And I think that speaks to, the three sources of that are obviously the down payment is off the top. There is a price escalation. So if you looked at that data, it would be what was the price increases from 2002 to 2007. And then there's the month-to-month chipping away at the capital for families. That's the outcome that Trillium Housing is looking for to help kind of break families out of kind of day-to-day expenses and to start building family assets. Next, I have a slide about the either secondary positives that come out of access to affordable homes. Also, some of the data that are referred to is for affordable home ownership. I think I'm probably speaking to an audience that realizes that good quality housing is critical to all aspects of life. Flick over that one quickly in the interest of time. Let's go. Here's our current projects. Come back. There we go. So top right is the loop, which you saw in the very first picture. We have two projects in Hamilton, one on the mountain, where we're doing 71 street towns, and a second project in Winona, just off the QEW, where we're doing just over 60 street towns. Those projects are with a local developer named New Horizons. Jeff Bacon is the developer. And we've been working with the city on accessing support. The third site in the bottom left, or the fourth, is Duffin Heights in Pickering. We just had City Council approve on Monday night the zoning and OPA, and we're going to do over 200, up to 260 stacked townhouses on that site. And again, we're quite excited about that and the work we're doing with CMHC to support it. Our developer on that project, as well as Toronto, is Van Mark Constructors, who I think are very active and well known in British Columbia and also here in Southern Ontario. So we're looking to work with quality, and both of these groups have been around for many decades. Quality builders, as we as a shared equity kind of co-owner of the units. Good quality product is as important to us as it is to our homeowners. I have put some opportunities that come out of the SEMP and the shared equity initiatives, and because I think it is a great opportunity, not just for those nonprofits that are working in this field right now, but an opportunity for nonprofits across Canada who have sites. Potentially, I know several here in Toronto where a redevelopment would make sense in terms of the age of the stock and the need for renewal, or the opportunity that comes by increasing density. Having worked at the province and bearing many scars trying to get funding for programs, I know how difficult it is to get more money for expanding the rental product, but there may be opportunities now with the SEMP and the shared equity mortgages to look at affordable ownership, complementing the existing rental and doing some joint ventures that would allow some renewal and piggyback on the new opportunities. It's definitely an opportunity for us to work similar to the way Trillium Housing does, to bring in new conventional housing developers into the affordable space. This helps them sell the product to families who otherwise couldn't afford it. And I think the more we can do to give the market signals to develop entry-level product, the more quickly CMHC and the government can address their 2030 target. The SEMP was also, and this was to my very first slide, as an opportunity to leverage further investment into affordable housing. There's not a lot of investment product or opportunities, and there are people who want to help. And I hope that we'll have that opportunity to work with CMHC and SEMP. And really, it opens, this is a new front in the battle for housing affordability. It's not the same old that we've done in the past. I think it's new, and I credit the federal government and CMHC for opening this up for us. And that is my presentation. Thank you very much.
Thank you, Joe. Merci, Joe, pour la présentation. Now, please, Heather Tremaine, who is the CEO of Options for Homes, also in Toronto. So, Heather, bienvenue, and the virtual floor is all yours.
So as Jeff mentioned, I'm from Options for Homes. I'm mostly going to focus on the model that we have. I think Joe's covered off the benefits of affordable ownership. I don't think, and I'm sure most people on the phone are aware. So I'll focus on our model. I'm hoping. Why am I not? Okay. So we profit. Our mission is to provide the opportunity for people of moderate means to become homeowners and to build equity and improve the quality of life for themselves and their children. So we are very focused on, our sort of secret, our secret mission, we like to say sometimes, is really trying to redress the issues of income and wealth inequality. So that's what we are really trying to do through affordable ownership. We've been around this is our 25th year this year. This slide should likely be updated. We're just closing a project right now that will take us over 3,000 units completed. We've had a long-term partnership with Delterra, which is the third-party construction arm of Tridel. They are our builder. So we act as a developer, and we have a very strong relationship and long-term relationship with the builder. We have completed now 15 condos, and our down payment support, we actually, when we talk to the public, we say that we provide up to $95,000 in down payment support. In reality, it's more than that in our current project, but what we found is that people didn't believe us when we said that we delivered over $100,000 in down payment support, that there was a skepticism that came back from people, that it was a little bit too good to be true. So we sort of downplayed it in most of our communication pieces. This is the essence of the model, if you will. We act as a developer, Options for Homes, and we create new communities. And I will say that we do believe very strongly in building communities. We actually use a co-op structure for the development, and we bring the purchasers together many times during the development process. So when people move into our buildings, there is already a very strong sense of community in the buildings. So that's the create part of it. And we invest with our purchasers, providing them with a down payment support. And then when people repay those funds to us, so that when they come back to us, they are pooled as in a separate entity, but that provides us with the equity to create new projects. So our model actually came out of we were started in the mid-90s when government wasn't funding, when the federal government pulled out of housing in a significant way. So this was a response our model was very much a response to that, saying, how can we deliver housing in a self-sufficient way? So we now have our own equity fund that's worth over $100 million that we have access to, that enables us to act in an entrepreneurial fashion. When we see a new site, we can pursue it. We don't have to wait for government funding to secure a site. So this is a bit more detail. So there's two sides to our to our model. Options for Homes, as I mentioned, is the development side. And then Homeownership Alternatives is our fund side. And those two parts are separated and have each is its own nonprofit. Each has its own board of directors. So if you look at the left-hand side, we sell our units at market. And obviously there's a cost to deliver that. Typically it's 85% of the market cost is what it costs us to deliver. So this remaining amount, which would be a profit in a conventional development, rather than collecting those monies at the point of sale, we provide those funds to our purchasers as down payment support. So it's you could refer to it as a deferred profit, if we were for-profit groups, and that is secured on the title of their unit with a second mortgage. So that's the kind of simple version of it. And then the way the fund works is that Homeownership Alternatives holds that second mortgage, and when those funds are paid out, they come back into the fund and are therefore available to us on the development side to purchase land and to fund the early stages of our project. So that's the kind of two key components. I'll also explain what this looks like in, how the down payment support works. And it's similar to Joe's model in some ways, and Joe used to work at Homeownership Alternatives. So that you'll see some similarities in the two models. Similar to Trillium, there is no payment required during the term that the second mortgage is in place. People instead pay out or share in appreciation. And I'll talk more about that later. But this is how we bring down the entry point for ownership on the income side. So this is now a mythical home price in Toronto of $300,000. If it was a market purchase, our purchasers are all required to put 5% down, so they need to have some skin in the game, if you will. And in a conventional market purchase, the household income, and this really depends on whether if they're borrowing from a credit union or if they're borrowing from a bank, because this is the difference of the stress test, really, that you see in the household incomes. And then we can layer on in the kind of second, in the middle of the slide, we can layer on our loan. And then as we move kind of over, we can also layer on government support. So now in the city of Toronto, the city is willing to defer 400 development charges per year. So we would layer that on. We bundle it with our second mortgage, and we actually administer those funds on behalf of the city. So you can see the stepping down of the income as we add additional support into the system, and making the unit more accessible to a lower income family. And this is what it looks like. Again, it's that $300,000 home. Someone purchases it, they put down their 5%. We're providing the 45%. The rest is secure. The rest, they go to the a conventional bank and get their mortgage, and they go there, run through the due diligence by the bank. And then ideally what we're trying to do is get someone who has previously been a renter into the position of owning. So that's the kind of equivalency we're trying to create here. And then you'll see what happens 5 years later. The unit is now worth, we've escalated by 3% a year, so it's now worth $382,000. They pay back the bank, they repay us with our appreciation, and now they've gone from having put $15,000 down to having $116,000 in equity. So that is the difference that we can make in for our purchasers. That's the kind of essence, I would say, of the model. I think the large benefit for nonprofits, and particularly now with the SEMP funds, is the ability to, if people are able to access some of the SEMP funds for pre-construction, then people could start doing these kinds of projects themselves and realize the gain on the backside of the project. We now have been able to scale from really what was a kind of a bootstrap organization where we had a piece of land we were able to access and a fair bit of pro bono and in-kind contributions. We were able to take that and turn it into a $100 million fund, obviously over time. But, we are now a significant scale developer. We've closed over 500 units this year. We have another 120 in construction, and we have a pipeline of 2,200 units that are in some stage of development. So I think that's the sort of the potential and capacity of a model like this, that it could also be a tremendous support to other nonprofits who are wanting to do housing in a number of ways. This has the capacity and ability to generate equity that can be used to deliver housing. That's it for me, really. That's the kind of core of what I wanted to share today.
Thank you, Heather, for that very good overview. Merci, Heather, pour la présentation. So I'd now like to turn to, again, our final, but our last but certainly not least speaker, Patrick Pretty, who is the project coordinator at the Société d'Habitation et de Développement de Montréal. And that is the group that runs Accès Condo program in Montreal. Patrick, the virtual floor is now yours.
Thank you. Well, thank you for this invitation. I'll make a quick presentation of the SHDM, and then I will switch to the Accès Condo program itself.
And Patrick, could we just ask, would you play your slides?
I'm sorry. Okay, is that working?
We're good, thank you.
Okay, we're good. Okay, thank you. So I will start with SHDM at a glance quite quickly, because we do a lot of projects, commercial and residential, and we'll look more closely for the Accès Condo program. And at the end, we will look at after some problems we have with the program right now and look for some solutions. So we are an expert in property investment. We're a non-profit paramunicipal corporation, and we do not depend on the City of Montreal. We don't use any subsidies or funding from the city. And we're involved with the economic, social, and cultural development of the city. Accès Condo has been in business for, well, more than 10 years. It's 12, 13 years now.
started in 2005. We accredit affordable and quality projects in Montreal. We go through public call of proposals and we determine the most interesting projects the developers are proposing to us. And we have several criteria. In particular, we stress over the quality of the architecture, and we look after the location of the projects because we work with the City of Montreal for the best place to put an accès condo projects together. We facilitate home ownership for those who wish to buy in Montreal. Well, to facilitate that, we provide a purchase credit of 10%. And the City of Montreal is also giving subsidies for first-time buyer. I have to stress out that the buyers that come to us to an accès condo projects, there are only two conditions. They have to make a deposit of $1,000. There's no 5% down payment. It's only a $1,000 down payment, and they have to live in the unit. So the entrance to the program is very simple. Third, we target areas in order to contribute to the social and economic resilience. Oh, sorry, it's impossible to say. We're talking about unstructured environment, former industrial areas, places where developers don't want to go because the risk of the sales is much too high. But accès condo and accès condo projects can go there. I will explain later on how that's possible. Well, we have a few pictures of our accès condo buyers. As I said, we stress for good-looking architecture. Some few figures, we're close to 4,000 units, 32 projects in 10 boroughs. We've got lots of young people, 71%. 67% would not have purchased without the program. We also force the developers to make 3 bedrooms units because they usually make 1 bedroom and 2 bedrooms projects, but we want to keep families in Montreal because we're losing people. Montreal is an island, so many people are going out in the suburbs. And one of our goal is to keep people in Montreal, and we have to build bigger units with more bedrooms. And from our information, 85% of the households were tenants before the purchase. And when we built with the various developers we're working with, we've integrated 800 social units with accès condo units. So the way it works, it's a risk. We sign an accès condo agreement with a developer. It's basically a risk sharing agreement. We take the risk of the sales, and the developer takes the risk of the construction itself, all the professional fees, the land, the construction itself. So that's the way it works. We have the construction quality control. I was talking about quality architecture and construction quality. We have the control over the sales price, and we take charge of the promotion and sales because we are taking the risk of the sales. This is a comparison between a traditional condo projects and an accès condo project. The main difference between the two models is that we do not require the pre-sales of the units of a traditional project because we take the risk of the sales. All the units are pre-sold, so this area of time is removed, and the other part is at the end of the traditional condo project is the detention cost of the units that are also brought down. So in Accès Condo project, the developer can go right through the bank because we guarantee all the sales. So the intermediate financing is obtainable right off when we sign the Accès Condo agreement. If the units are not sold 4 months after completion, we will finance all the units. That's our risk. But after so many projects, that part of the deal is hardly used. This is a quick overview of the savings basically we have with the Accès Condo project. Well, first I was talking about the 10% purchase credit. The taxes are lower because the price is lower. The marketing price cost is lower because there's no pre-sales, so we cut down the marketing. Interim financing is also lower because there's no, the project takes a shorter time, so the financing is much lower. We do not customize the units. There's no pool, there's no special ceramic or anything. We have only 2 standard options, black or black. I'm joking. We don't have any special common areas, so there's no pool, gym, terrace, or anything. And we try to target land that is affordable. We don't usually work close to downtown because as you go closer to downtown, the land goes up, the price of the land goes up. We try to avoid that. So that's for the economy. I apologize for this drawing, it's very simple, but that's the caramel secret of the Accès Condo program. The rectangle represents the sales price, okay? The first chunk of the bar goes to us. It pays, the 5% pays for our sales, for the sales expenses, the sales office, sales people, everything. The second chunk of the bar goes for the customer, so it is the purchase credit. And the last part of the ceramic bar goes to the construction cost, goes to the developer. It is important to stress this this drawing because we work with the market value. We don't pour in fresh money. It's based on the market value. This model is fragile because the construction costs on bottom at 85%. We'll see that later on. The custom costs have a tendency to go up, and it crushes our fees or the purchase credit. And when this happens, we are not able to sign an Accès Condo agreement unless we put money in, but we never do that. So that's the way the Accès Condo program works. So we've seen that building Accès Condo projects are costing less money. Marketing Accès Condo is faster and less risky. And Accès Condo units benefit from a 10% purchase credit plus some subsidies from the City of Montreal that first buyers can have. We don't have that criteria for our buyers. The only 2 criteria are very simple. They have to make a $1,000 deposit and they have to live in the unit. If the buyer is a first-time buyer, they can have an additional subsidies from the City of Montreal. A few pictures of our last, some of the many projects we did. I'll go through that quite quickly, but you can look at the quality of the architecture. Some interesting feature with La Biscuiterie was a former cookie factory, and we did La Confiserie, a former candy factory. And there's La Fabrique, which was a former clothing factory with deep concrete floors. We did also Faubourg Contrecoeur. Bassin du Nouveau Havre is our latest project. Looking ahead, those are the problems we're facing. In big cities, Montreal, Toronto, we face a lack of land to develop. The cost of land is going higher and higher. And the land is also affected with what I call the brownfield effect. The contamination of the land as you work in cities is always a problem, and it brings additional cost. We have the development fees. I was talking about the construction costs that are rising because there's a problem with the skilled workmanship that we're missing people on the construction market, so the prices are going up, and it's causing us problems to close the turnkey prices. Buyers have difficulty to qualify. New rules have been put on lately, and they have buyers have to pass a stress test at the bank to make sure they can pay the mortgage if there's a raise of the interest rate. Change mortgage loan insurance rules. Also, stagnating housing market. I have to correct that. It's varying housing market. We have to make a close monitoring of the housing market to make sure we are right on. And many of the projects we work on we have some delays with the planning approval process. The zoning has to be changed because we work into areas that are under major changes. Some of those areas are former industrial areas, so there's a lot of zoning and preparations to be done. Looking ahead, solutions, increasing the purchase credit. We do that not very often. We did it once, but usually we'll keep it at 10%. Developing mixed housing project. We're doing that with social units, but we can do it with private condo units also. Seeking public properties would be a very good avenue because the cities have access to some part of the lands that are underused. We could work like there's a Build Toronto that works in that way. They seek public properties for redevelopment. Integrating inclusionary housing policy could be another way to work with those problems. Reviewing the terms of the ownership programs, well, obviously. Counseling for home buyers, it's important because the home buyers have trouble passing the credit test, and we lose a lot of people when they apply for an accès condo unit. Their credit has to be rebuilt, and their file is not accepted at the bank. And finally, we could look into with perhaps partnering with a financial institution. The last slide is something we've seen together with Trillium and Options for Homes and all the other participants. So we have the comparison of a purchase. So the purchase price at 200,000, you have the purchase credit of 10%, 20,000. The minimum buyer contribution, $1,000 I was talking about. It's not the 5% we ask, it's only $1,000. So the mortgage will be $179. 5 years later, if we have a selling price of 220,000, we have an increase of value of 20,000. The purchase credit has to be repaid, 20,000, and we cash in also an increase in value of 10%, so it's 2,000. The reimbursement will be $22,000. So the resale equity will be 220,000. Total SHDM reimbursement 22,000. Mortgage balance would be at the time of resale 153,000. So the final resale equity would be 45,000. So that's my presentation of Accès Condo. Thank you all.
Well, thank
Do
you.
have any questions?
Thank you, Patrick. Merci, Patrick, pour la présentation. If folks do have questions for the presenters, this is now the time to type those into the box on your screen. I will just, however, say, Patrick, during your presentation that given that some of the folks on this webinar may be in other time zones in the country and are at lunch, that the references you made to caramel bars and candy and cookies may be making some people very hungry, though.
I was joking.
We won't have a lot of people running off to the lunchroom just yet. But if you have questions, please type those in. I do have one for Patrick, Heather, and Joe. We heard from Catherine that new SEMP fund is not stackable between its two streams. I'm wondering if you've been able to stack any of your projects with other forms of CMHC capital funds, such as seed funding, or perhaps too early to ask about co-investment fund, IH, any of those type of funds. Have you been able to stack or access CMHC funds, other CMHC funds?
Not on our side. This is Patrick Pretty. No, we're not able to do that. Perhaps we could, but
we've had seed funds in all of our projects. We are currently through the I3C committee of the Innovation Fund as part of the new National Housing Strategy funds for our Pickering project. So we're into the due diligence process, and there is the seed. So now they're quite different. So I don't see the blockage there. I'm not sure, and Catherine mentioned that projects couldn't do both. We have two projects ready to go to the market in September in Hamilton. We could bring in pre-construction funding under the first tranche and then fund mortgages for occupancy next fall. With street towns, we'll sell out quickly and build in a year. So that I don't know if we can't stack in terms of timing, as in we get one and repay it and then draw from the other later, or if it's just by project. But I guess if Catherine can clarify, that would be great. But I could see that working. I have talked to the partnership group at CMHC, Adam Stratus and Debbie Stewart and others about projects like ours that I count up to I think 6 or 7 different touches with CMHC on one project potentially, because we haven't even talked about the co-investment fund and access to construction financing. So whether there's a mechanism to focus on the client or the project and approach it holistically in terms of what different supports are available, I think there's a great opportunity there, particularly if we want to scale the activity and get more projects done. Sorry for the lengthy answer to the question.
In terms of options, we have not received additional support from CMHC to date, other than the seed funding. That's all that we've received. I mean, we're looking forward to the SEMP funding. We think that will make a big both sides, on the pre-construction and on the takeout side. But I think you can see the kind of power of stacking. Like, you could see it in the model with the City of Toronto, where they provide the development charge deferrals, and you can start to see that you can actually achieve much lower incomes. If you want to talk about kind of, building a middle class, then I think the idea of being able to stack those is actually, when you add a group like ours and you add city monies and potentially something, other second mortgage monies or shared equity monies, then you can see the power of that stacking and what you can achieve in terms of moderate income, especially in high value markets.
Great, thank you everyone. So we do have a couple questions. I will just answer one question. A couple folks have asked whether these slides will be available. The answer is yes, they will be on the CHRA website within a couple days, so you'll have full access to them. So I have a question first of all for Joe. Joe, the question is, generally when the homeowner sells, would the homeowner generally move up in the housing spectrum, or would they at least stay kind of at par?
Hello. Having had some experience, as Heather mentioned, at HOA where there's a portfolio of mortgages, we know that there was great appreciation in the value of the homes, and that those homeowners were quite dutiful at paying down their mortgages. So they certainly had the assets to move up. I know that we didn't, and I don't have any kind of longitudinal studies that show, this is what they moved on to. I believe Habitat and they're, although they kind of source support through their volunteer labor model, they do have a form of second mortgage. Often in every area is different, but they often have a second mortgage, so it's an important aspect of their program as well. I know they've done some longer term studies on the families, and I think and CMHC was a sponsor of that. And showed some very positive outcomes, not just in terms of equity build, but also in terms of health and education outcomes for the children and community engagement and other things. So I guess softer outcomes, but also quite very positive for the community. I want to just take 1 second and go back to that stacking question, because there's a large difference between the ownership proponents that are here talking about our projects, where the support that we've been provided has all been loans from government, and I'm thinking of Heather's reference to the City of Toronto, the old IAH program, the SEED, versus the conventional non-stacking of rental supports, which are pretty much universally grant based. So if the CMHC is getting fully repaid their funds, and it's, I don't see the need to not allow the stacking, particularly if they're consecutive. But I just added that out there, maybe as some lobbying to Catherine, to think that this is the support being provided is actually quite different than a $150,000 a door IAH grant provided to a private landlord versus a loan into one of these projects.
For all three, Heather, Joe, and Patrick. And Heather, maybe we can start with you on this one. The question is, assuming the models use a secondary mortgage on title, when the homeowner wants to pay off the secondary mortgage, who pays the change of title costs? Heather, would you be able to respond to that?
Typically, sure. Typically, when typically people are when that mortgage is coming off title, it's when they're selling the unit. So they would typically pay that charge. It's not a significant amount. It's really just the legal cost or a discharge. So it's not significant.
Thank you. Patrick, do you have anything to add to that?
Well, actually, the buyers are paying for that fee. It's not have the same answer. They're paying for that fee. It's not a big amount.
And Joe, is anything to add?
No, I don't think I have much to add, other than, again, compared to the appreciation over time, it's not substantial. I would say that there are voluntary repayments particularly as families year 5 refinance their first mortgages, and the banks are looking to increase their first mortgages. There are discharges, but usually the family has been set up for success at that point. They can afford the bigger mortgage. Those transaction fees, I think, are relatively secondary compared to the other benefits that they've reaped over the years of having the payment-free mortgage.
So we have another question, and this is a continuation of the discussion. It looks on stacking and coupling. And the question was, what about coupling or stacking with the CMHC Federal Lands Initiative to access surplus federal lands? For Joe, Heather, or Patrick, has that factored into any of your plans? And maybe we can start with Patrick on that one.
Yes, we did one project, one accès condo projects with that kind of a program a long time ago, but we did it only once. The opportunity are not very, they do not appear very often, but yes, it is a possibility. Yes, and we're.
Sorry, and Joe, do you have anything to respond?
I could go on at length, unfortunately. All 4 of our current sites are surplus government land. 3 of them are from the province of Ontario, and I worked with the nonprofit network, Ontario Nonprofit Network, through the Open for Business program about 8 years ago to negotiate access for nonprofits in Ontario on the same basis that lands are sold to other levels of government. So we've been able to take advantage of that, pay market rates for the land, but we get access to review whether they're suitable or not before they go on the open market. With the City of Toronto site, the loop that I mentioned before, it was a competitive process where we paid full market value on a competitive basis, but they did prioritize housing affordability being delivered. We made submissions with regard to the new Federal Lands Initiative. We did actually apply to purchase one of the sites that was recently tendered. Although the front page said they welcomed affordable ownership projects, anyone who looked at the material or the forms that were put online would not have been able to fill them out as an ownership project because they were uniquely designed for rental projects. You know, I think there's some catching up to be done with respect to the Federal Lands Initiative and things like the SEMP and the other federal programs that are rolled out because they're not currently aligned. And you know, I know there's a lot going on, but I think there's some missed opportunities there.
And sorry, and Heather, did you want to add any reactions?
Sure. I mean, we haven't worked with the Federal Lands Initiative yet. We hope to. But I think what's interesting, what they've done in British Columbia, is they've actually tried to capture, through the BC Housing Program, some of the value that government can provide in shared equity in affordable ownership. So if the province were to provide land and that land was discounted, that discount could be captured in a second mortgage, in the value of a second mortgage. So I think there are opportunities for land to be used and leveraged to provide deeper affordability in some cases, and that value can be captured by government, administered by groups like ours, and retained essentially. So I think there's some creative ways to look at how land could actually be used in these instances.
Great. Well, thank you. So before signing off, it looks like we're at the end of our questions, but before signing off, I did just again want to remind people that if you're interested in this sector and learning more or wanting to participate more in the affordable homeownership sector, that CHRA has just launched an affordable homeownership working group for CHRA members. If you're interested in taking part in that, please email Dominika Szyminska, and her email is on the website. and she'll be in touch probably in the next 2 weeks or so with members who've indicated their interest in setting up a first meeting. So with that, I wanted to say once again a huge thank you to our presenters, Catherine, Joe, Heather, and Patrick. This was incredibly informative, in particular dealing with a sector and a model that probably is not as well understood among the community housing sector. So we appreciate you sharing your experiences and your information, and Catherine, the updates on the new SEMP program. As I stated earlier, today's webinar will be shared on the website in the coming days, and you'll also all be emailed a survey about today's webinar that will help us plan for future webinars and about other things that you'd like to see. If you haven't already, please do sign up for our newsletter, which will provide information on upcoming webinars over the summer and fall. So with that, again, Catherine, Joe, Heather, Patrick, thank you. Thank you to everyone who's taken part in this presentation. And on behalf of CHRA, we want to wish you all a very happy and safe Canada Day. Merci à vous tous. Un bon jour du Canada. Have a great afternoon. Thank you.
Typically when that